So let's first talk about framing. How do you decide which pair to buy? How do you decide the best time to buy? And once you've made the decision to buy, when are you going to sell? These questions and how you answer them are a direct result of how you frame the question, thus directly impacting your trading performance. And worst case scenario is some people don't even ask the questions. They just go on a whim, which is absolutely the worst idea. If you're buying things from a gut instinct perspective, you think you can just go out and kind of guess the markets better than everyone else. I call it people thinking that they can panic better than everyone else. I've never seen anyone make money ever because they could just simply panic better. Everybody that I've ever known in the financial markets has some sort of game plan, and they have framed the questions the right way. Think about what we just discussed with our trading plan. We framed which pair we're going to buy. We're going to buy the one that's in a nice bullish pattern. We framed how and when we're going to buy, when it breaks through resistance of this nice high base pattern. And then we discussed when we're going to sell. Either A, it falls to the stop loss, or B, it rises to the target. We framed these questions to create a nice risk to reward. If you don't frame them in that way, then essentially you're buying blind and you're selling blind. And I promise you, as I've said a number of times already, you're instinctively going to hold your losers and cut your winners. You're instinctively going to cut your flowers down and let your weeds grow. So please frame these questions and then build around that. Framing determines the viewpoint from which we look at an issue, such as a chart. In essence, framing acts as a filter determining what information is important and what is not important. If we have not created a frame, or if the frame is constantly changing to satisfy current emotional imbalances, then our performance will suffer accordingly. I've noticed that traders will go through different emotional imbalances, and some of it's life. The worst idea I've ever heard of is to trade when you're emotionally checked out. So if you're on vacation, if you're moving, if you're going through a divorce, these are all periods that are very detrimental because in some cases, well, let's use the most extreme example, going through a divorce, you're actually in an emotional state that has way too many highs and lows in that type of scenario. And oddly enough, there have been numerous examples where people have, in essence, kind of sabotaged themselves to almost make themselves feel worse during this period of time. So trust me when I say that emotionally, you're going to go through ups and downs in your life. You're going to have positive and negative emotional responses. Some days you come in and you slept well and you're just in a cheery mood. Well, you're gonna make trading decisions based on that mood that are different than the next day when you didn't sleep at all, you're grumpy, you're hungry, and now you're going to make trading decisions in that state of mind. This is why, again, trading around a framework is so important. If you simply are trading technical patterns based on risk to reward, it doesn't matter your emotional imbalances because it's just a framework you're working off of, right? It's like going to your job and your job is to, do something on a conveyor belt, okay? Well, it's just a system. So it probably doesn't matter that much what your emotional state is because you simply have your job laid out for you and you do it almost without thinking, right? Which in the financial markets is a protective measure to keep you protected from yourself.